Can we start?
Sure, sir.
Yes.
Okay, so we have done with all the quantitative measures, right? So now we need to do the qualitative measures. So you can give the heading qualitative measures. Qualitative measures. Okay, so the first one is credit rationing. Credit rationing. See, what is the difference between quantitative and qualitative measures? Quantitative measures, if you see, it will affect the money supply, overall money supply. But when it comes to qualitative measures, it will affect a particular sector. Okay, so it will be sector wise. So you can say the first one, credit rationing. You write one line over there. Credit rationing means it is basically fixing a quota. Fixing quota like priority sector lendings, etc. So just write one line there. Under this, central bank fixes quota of credit. Central bank fixes quota of credit for various sectors of economy. For various sectors of economy. For example, priority sector lending. For example, priority sector lending. What are the priority sectors? You can write there if you want. Priority sectors. Main priority sectors you can write there. Agriculture. Weaker sections. Agriculture, weaker sections. Okay. MSMEs. Then home loans up to 25 lakhs. Home loans up to 25 lakhs, education loan, etc. etc. Okay, so this kinds of loans. So these are priority sectors. So what is the limit? Up to, at least 40% of the total credit. So at least 40% of total credit you have to lend to the weaker section. So any bank, let's say 100 crore is the total credit, out of which 40%, minimum 40 crore minimum has to be given to the weaker section, okay, or this priority sectors. So that's what priority sector lending. See, this credit, it is technically, you will see some textbooks A and B C. What is this A and B C? Any idea what is A and B C?
Adjusted net bank credit, sir.
Yes, you can write there adjusted net bank credit. Okay, now for example, if you talk about agriculture, within agriculture, see, within this 40%, I've told you that priority sector minimum 40%. Within this, there are subdivisions. For example, agriculture, it is 18%. Okay, weaker section, it is 10%. So this is minimum 18%, minimum 18%, minimum 10%, means at least 10%. And within agriculture, further within this 18%, 8% is for small and marginal farmers. Small and marginal farmers up to 2 hectares of land. Okay, so these are some minute facts. So what I'm saying is credit rationing. So RBI will fix the quota with respect to different sectors. So for example, priority sector lending, minimum 40% you have to give it to priority sector, minimum 40% of A and B C, adjusted net bank credit. Okay, now what about foreign banks? Do they have this priority sector lending? Foreign banks?
Yes, sir.
Is there any relaxation for them, or is for them also it is 40%?
I think 32%.
Yeah, foreign bank. See, foreign bank is divided into 2 categories. If they have branches more than 20, if more than 20 branches are there in India, when we talk about foreign banks, not across the world, So in India, if more than 20 branches are there, obviously more than 20 branches will be there for most of the foreign banks. So more than 20 branches, it is 40%. Okay, less than 20 branches, then 32%. But this will be increased to 40 by 2020. It will be increased soon. Okay. Now if you see 6-7 years back, it was common. It was 32% for all. It doesn't matter what is the number of branch. For all foreign banks, it was 32% before, around 7 years back. But now more than 20 branches, 40%, less than 20 branch, 32%. It will be increased to 40 soon. Okay, next you can write margin requirements. Margin requirements. So that means that is a second qualitative measure. You can write under that, it is a difference between, market value of a collateral security, and the maximum amount of loan, that can be sanctioned by a bank against it. In a particular sector. So for example, when we talk about collateral security, let's say you have 1.2 lakh is actually the market value of land or whatever it is. Okay, so if you need loan of 1 lakh, so this difference is what we call as the margin requirement. So anyway, it will be more than the loan amount. Okay, so here now in this context, the margin required is actually 20,000 extra. So what RBI can do is RBI can actually ask the bank to reduce this margin requirement. So like for example 1 lakh loan, you can pledge the property of 1.05 lakh like this. So here the margin is reduced. So instead of 20,000, it is now 5,000. So the chances of getting loans are more, and it will be done in some specific sectors where RBI want to pump more money. Okay, so in that particular sector, money supply will increase. So I hope you understood what you mean by margin requirement. And it will vary from sector to sector. So here you can see the margin requirement is 20%. So it can be reduced to 5% or it can be reduced to 2%, right? So more the margin requirement, the money supply to that particular sector will come down. Less the margin requirement, the money supply to that particular sector will increase because the access to credit is more now. Okay, so if RBI want to discourage money supply to a particular sector, what RBI can do?
Increase the margin.
Increase the margin requirement. Yeah. So next one you write ceiling on credit. Ceiling on credit. Under that you write RBI fixes maximum amount of loan. RBI fixes maximum amount of loan which can be provided to a unit, in a particular sector, by a bank. So you can see that from the name itself, ceiling on credit. So RBI fixes the maximum amount of loan which can be given to a particular sector. So under that you can write A, the first one, differential rate of interest. Differential rate of interest. Differential rate of interest. So you write there, central bank prescribes different rates of interest. Central bank prescribes different rates of interest for different sectors. Different rates of interest for different sectors. Okay, so it can be different ceiling on credit for so here it will be ceiling on interest will be different for different sectors. For let's say agriculture, it can be maybe 4%. For some other sector, it can be 5%. So it is based on ceiling on interest upon different sectors. Okay. Second, under this you can write B. You can write differential lending norms. Differential lending norms. Okay, differential lending norms, and that is self-explanatory. Like it can be different in case of different sectors. For example, it can be liberal for agriculture sector, so that you can pump more money into that particular sector. When I say this differential lending norms, it includes all these documentation, all these things, right? Even just by coming up with an Aadhaar, you may be able to get the loan, all those things. Okay, so simple documentation, etc. So differential lending norms for different sectors based on the importance. Okay, so if RBI want to pump money to a particular sector, the lending norms could be liberalized. Okay, now so two measures we have done. Now write the third one. Simply you write other. So we talked about quantitative and we have talked about qualitative. Now you write third one. Apart from quantitative and qualitative, simply you can write other measures. Other measures. It can be qualitative, it can be qualitative, it can be quantitative or qualitative, and not much significant also from exam point of view. So just write other measures. Other measures. So first one under this, moral suasion. Moral suasion. Okay, means moral pressure actually. So just write a line under that. Under this, central bank advises banks to follow certain norms. Banks to follow certain norms through letters, circulars, seminars, speeches, etc. Okay, comma, banks are morally obliged to follow such advices. Banks are morally obliged to follow such advices. So here morally obliged, no legal requirements. Okay, so it can be in general like quantitative also, it can be qualitative, that means it can be a particular sector also. So if it is specific to a sector, it can be qualitative. If it is general, it can be quantitative, but not important. These are not legal requirements. Okay, and less effective also. Under this next one you can write direct action. So A, moral suasion, B, direct action. B, direct action. If banks fail to follow instructions given by RBI, it can take disciplinary action. It can take disciplinary action. For example, there can be penalty or sanctions, or to some extent it can be cancellation of license also. Okay, so direct action. So with that we have completed our monetary policy. So we basically talked about quantitative measures. So first one, what are the quantitative measures? We talked about CRR, we talked about SLR, we talked about bank rate. Okay, then we discussed about repo and reverse repo, and repo rate and reverse repo rate also, marginal standing facility. Then we have discussed about market stabilization scheme. So all these are done under quantitative. Then in qualitative we have talked about credit rationing, ceiling on credit, etc. Then this is qualitative, and we have seen other measures like moral suasion and direct action, etc. So any doubts in any of this discussion? Okay, can we move towards types of monetary policy? Types of monetary policy. So what are the two types of monetary policy? There are two types of monetary policy: contractionary monetary policy and expansionary monetary policy, or dear money policy. Okay, so that's what. Okay, first you write contractionary monetary policy. Contractionary monetary policy. You write it completely. In bracket you can write dear money policy. Money become more dearer here. Okay, money become more expensive here. So what you will okay, write one line under that. It seeks to reduce money supply in the economy. Money supply in the economy. It is pursued to control inflation. It is pursued to control inflation or to check depreciation of currency. Or to check depreciation of currency.
I'm not able to hear you properly, sir.
Sir, can you check?
Okay. So till what time we have went correct? You contractionary monetary policy you have written?
No, sir.
Okay. So types of monetary policy started?
Yes, sir.
So types of monetary policy, under that you write contractionary monetary policy, first one, or dear money policy. Contractionary monetary policy or dear money policy. So here the objective is basically to reduce money supply. So write one line. It seeks to reduce money supply. It seeks to reduce money supply in the economy. So its objective is to reduce money supply in the economy. It is pursued to control inflation. It is pursued to control inflation or to check depreciation of currency. So what are the objectives? To control inflation and also to check depreciation of currency. Am I audible now? Ashwin?
There's some issue with your voice, or it's not, it's breaking in between, here and there, not like frequently, but here and there it's breaking. But I just noticed the definition, sir.
Okay. So it seeks to control inflation and depreciation of currency. So how can you control the depreciation of currency here? For example, contractionary monetary policy means what? Money supply you will decrease. For that, what you will do with CRR, SLR, etc., all will increase or decrease. We have discussed yesterday.
Increase, sir.
You will increase everything, right? So you will CRR you will increase. Okay, SLR you will increase. Repo you will increase. Reverse repo you will increase. Bank rate you will increase. MSF you will increase. And you will sell bond or buy bond. You will sell government security or buy government security.
The cell phones.
Sell, right? So that you can suck out the money supply. So all these are done to reduce money supply. Now I am saying, when we are discussing about reducing money supply, many times we have talked about inflation. It will reduce inflation. But how will it affect depreciation of currency? Can we say depreciation of currency will also be affected here? Or we can also check depreciation of currency by increasing repo?
Sir, we create a demand for that money. We create a demand for rupee. We create a virtual demand for rupee by sucking it out from the economy. So
No. That is not what I am looking for. It is all about demand supply. But actually, what is happening when money supply is less? What is happening? How is it connected? When money supply is reduced, what will happen? Your purchasing power will come down, right? In the entire economy. So the aggregate demand will decrease for anything and everything. So here aggregate demand for dollar will come down or not? Demand for dollar will come down. When you have money, then only you will demand dollar, no? So when you don't have money, you won't demand dollar. You can see here, if you go with this is, let's say, demand of dollar, okay? and this is, let's say, supply of dollar, and this is quantity of dollar, and this is the price of dollar in terms of rupee. So at this situation, let's say 67. Okay, now imagine RBI is going to increase all these rates, so money supply will come down. So what will happen? Demand will come down because you don't have money. Yes or no? So demand will come down means what will happen with the demand curve? Shift rightward or leftward?
Shift leftwards.
Leftward. So demand curve shift leftward, right? Like this. So you can see here, this is a point now meeting the supply. So you can connect these 2 points. So you can see here the price of dollar is coming down. Price of dollar is coming down means, let's say, 67 to 60. This is what you call as appreciation of rupee. So when money supply is not there, demand for dollar will come down, so that lead to appreciation of rupee. So you can check, can you check the depreciation of rupee here by increasing the interest rates?
Sir, excuse me, sir. Sorry to intervene.
Tell me.
This concept of linking the money sucking out and dollars demand is a little bit of
See,
confusion.
when you will buy demand, when you will buy dollar, for that you need to pay money, right? You need to pay rupee.
Hello, sir.
Tell me, Mahesh.
Sir, if money increases, mean increase in exports also, sir.
Which one?
Exports, sir.
Depreciation. That is
It leads to the appreciation of rupee.
no. In case of depreciation of rupee, only export will increase. Not in case of appreciation. In case of appreciation, exporters will get less because exporters are get paid in what? In dollar. So if $1 is 67, then it is good for whom? It is good for exporters, so they will export. But if dollar is 60, the exporters are losing, no? So depreciation is good for export. We have nothing to do with export at this point of time. Rupee depreciation is required. That is why China devaluing. No, why China is devaluing? To promote their export, or at least to maintain their export. Okay.
Okay, sir.
So we don't want to discuss about that. Yeah, Ashwin, what I'm saying is, if you need to demand dollar, first of all, what is required? You need rupee. Without rupee, you cannot demand dollar. You need money in your hand to demand dollar. So if money supply is decreasing, you don't have money, or in the market money is less. So in the market, demand for dollar will be less automatically. If demand for dollar is less, means the price of dollar will come down. Price of dollar coming down means appreciation of rupee.
So it's indirectly like some kind of cascading effect.
No, indirectly. This is direct relation because you need money to buy dollar. If you need to create demand for dollar, you need money. If you don't have money, if you don't have ability to buy, if you don't have the purchasing power to buy, it won't create demand. So it is a direct relation. There is nothing indirect here. So when the money supply is controlled, automatically inflation is controlled. Secondly, depreciation of dollar is also controlled. Depreciation of rupee also controlled. So by increasing the interest rates, you are controlling money supply. That means you are going for dear money policy. That means making money more dearer, making money more costlier. That's what you mean by dearer money policy. So purchasing power will come down, aggregate demand will come down. So what is the impact? You can see here on one side, you can tackle the problem of depreciation. On the other side, you can tackle the problem of inflation. Okay, so till now we were talking about inflation only. Now I have introduced this depreciation concept also. Is it accepted? Because if it can control inflation, if you can reduce the price, automatically that same will happen with the case of dollar also, no? Because dollar demand also come down. So dollar price will come down. Dollar price will come down means rupee appreciating. Yes or no? Any others?
Yes, sir.
Any doubts? Any others? Confusion is there or not? So RBI can check depreciation of rupee by decreasing money supply. The problem with depreciation of rupee is what? Dollar is a hard currency, the demand for dollar is high. See the demand, if you see money supply is more, what will happen? The demand will go like this. Demand for dollar will go like this, rightward shift. So you can see this is a new point. See the increase in prices. That's why it is becoming 75 rupee or 80 rupee. Now this demand can come down when money supply is reduced. So if money supply is more, it will go like this. If money supply is less, it will come like this. Okay. So to check depreciation and inflation, what you need to do? What do you need to do? With which policy you need to follow? Contractionary or expansionary? See, people will have confusion with this. Every book you will see inflation, but people have confusion with this. So to check depreciation also, you will follow contractionary policy. Now when you are following contractionary policy, you are compromising what?
Growth.
You are compromising growth. Growth will actually come down. So till yesterday, I was talking about inflation and growth, and I've told you there is a monetary policy dilemma. Because if you try to control inflation, growth is coming down. If you try to promote growth, if you need to promote growth, you need to increase money supply. So inflation will be there. This is what monetary policy dilemma. But now RBI is facing a problem of what? Monetary policy trilemma. All these are connected. So if you increase money supply, what will happen? If you increase money supply, this is basically done for what? To promote growth. Growth will increase. But what will happen with depreciation of rupee? Rupee depreciate. Rupee depreciate, and also inflation will be there. Okay, so this is a monetary policy trilemma. Now if you control this, if you decrease money supply, what will happen? You can solve the problem of depreciation and you can solve the problem of inflation, but you have to compromise growth. Growth will come down. So this is what the trilemma. 3 parameters I've included. Normally we talk about this dilemma only, but here we are bringing about this third concept, depreciation.
Excuse me, sir.
Tell me.
Sir, can we say it like this, that to check the depreciation of currency, in the case of depreciation means more influx of goods in the market?
In case of depreciation,
Means more influx of goods in the market?
how is it happening?
Sir, because constant number of rupees is changing, more number of goods, then the value of goods are decreasing.
Yeah, value of goods are decreasing.
Then we can say that more influx of goods in the market.
No. When rupee depreciate, you can say export will increase. We
So
can't.
that is another thing. I just wanted to say that I just understood your concept. I just wanted to say, can we say it in the words like in the depreciation case, more influx of goods are in the market. So to check the production of those goods, RBI wants to suck out the money from the market. So it is applying the contractionary policy.
No, not in case of depreciation and influx of goods. There is not much connection. Obviously, export will increase and import will decrease. So influx of goods, I don't understand how is it coming, because when you are importing, import will become costlier for you. So you stop importing, because when you are importing, you need to pay it in terms of dollar. So when rupee depreciate, dollar price is high, so you need to pay more and more. For example, $1 is rupee 50, and tomorrow dollar appreciate means it is 60. So if you are buying a product, if you are importing with $1, earlier you are paying 50, now you are paying 60. So you will be discouraged to import. So there won't be influx of goods. Secondly, you will be motivated to export, because earlier you are getting 50, now you are getting 60. So more export and less import. So I don't think that will lead to influx of goods in the market.
Okay, sir.
Okay, so actually exports will increase and imports will decrease. But in India's case, it is a different context. It is there is a paradox of increase, despite the fact that rupee depreciating in India. What is happening? Imports increasing and exports are decreasing. There are many other reasons also that we'll discuss when we discuss about that balance of payment chapter. Okay, so let's not get into that discussion. That I'll discuss. India is a land of paradox for everything. So we will discuss that. But actually, conceptually, influx of goods will not come. How is it possible? Because when rupee depreciate, export will be more. People will be motivated to export, and people will be demotivated to import because you need to pay more for the import and you get more for the export. So exports will be more and import will be less. So influx of goods will not be there. So in case of contractionary monetary policy, money is dearer. So dear money policy. So you will increase all the interest rates. What about expansionary monetary policy? It is the opposite. Expansionary policy. So this is cheap money policy. Cheap money policy. So money is cheap here. Money is cheap means what? The cost of money is what? The cost of money is actually interest. So interest is less here. So expansionary monetary policy is done for what? To increase or decrease money supply?
Increase money supply.
To increase money supply. So can I say to promote growth, RBI will go for expansionary monetary policy?
Yes, sir.
Yes, basically to promote growth. If the objective is to promote growth, expansionary monetary policy. If the objective is to control inflation, contractionary monetary policy. If the objective is to control rupee depreciation, then contractionary monetary policy. So if that part is stable, because primary objective now after the Urjit Patel committee is actually to control the inflation. So if inflation is stable, then which policy RBI will adopt? Expansionary, because now your next objective is to promote growth. So now what you will do with the rates? CRR will increase or decrease? CRR will decrease so that you can create the credit more. So similarly SLR you will decrease, repo you will decrease, reverse repo you will decrease, okay, bank rate will be decreased, every rate, okay, MSF, everything will be decreased. You will buy or sell bonds?
Buy bonds.
Buy bonds.
Buy bonds so that you can pump money in the market. So this is what actually happening in the expansionary monetary policy. So here growth will increase, but what will happen ultimately? That lead to inflation and that lead to depreciation of rupee. So when this happening, then RBI again have to switch to contractionary monetary policy. So that's what the trilemma that we are talking about. All these are clear, the types of monetary policy now. Last year there was a question directly from this. Okay, now next is quantitative easing. So we are done with this. Now we will talk about another concept, quantitative easing, QE. So this is actually done by the developed countries. Okay, so developed countries like US, Japan, EU, etc. will pursue this policy, quantitative easing. It is basically done to increase money supply. Why they increase money supply is basically to increase the demand in the economy. Now this will not be done by developing country. The reason is already there is enough demand in the economy. So the problem with demand will be there with only developed countries, so they will do this. So it is similar to open market operation of the RBI. They will buy back the bonds by pumping huge amount of money in the market. Okay, so this is also a kind of cheap money policy. You can write one line over there. Their objective is basically to promote growth. Okay, so it is an unconventional monetary policy measure. It is an unconventional monetary policy measure which seek to stimulate economic growth, stimulate economic growth or counter recession. So if there is a threat of recession, they will go for quantitative easing to increase money supply, to increase demand and to increase the growth, to counter recession by increasing aggregate demand in the economy. By increasing aggregate demand in the economy. One more line you write, under quantitative easing, under QE, central bank, that means in case of US Federal Reserve, okay, in QE Federal Reserve, bracket you can write central bank of that particular country, purchases a predetermined value of bonds. Central bank purchases a predetermined value of bonds from financial institutions for a predetermined time period. Predetermined value of bonds. It can be government or it can be private bonds, okay? From financial institutions for a predetermined time period. It is pursued by developed countries. It is pursued by developed countries. So I've already told you, developing countries, there is no deficiency of demand and there is no need to do this kind of activity to create demand. Already demand is there. In developing country, if you pump money and if you try to create demand, that will lead to hyperinflation. So this will not be possible, or this will not be done in developing country. This will be pursued by the developed country. So if you see here, this is how it is going to work out. Central bank buy bonds, right? It can be private or government. So what will happen when you buy bonds? Money supply will increase or decrease? What will happen with money supply?
Increase, sir.
Money supply will increase. So what will happen with the demand? Increase.
Increases.
So economic growth will increase. Now let me ask you one more thing. When central bank buy bonds, don't you think it will create demand for bonds? The demand for bonds will be so high now.
Yes, sir.
So when the demand for bonds is high, the price of bonds, what will happen? Will it be high or less?
High, sir.
So when the price of bonds are high, what do you think will be the return on bond interest? Will be less or more?
Less, sir.
Less, right? Because what is the return? When you are buying a bond, let's say this is a bond, let's say face value is rupee 100. So for this bond, demand is more, means the price of this bond will be more, like 97, 96, etc. right? So the person who is quoting the maximum amount will get it. So 97 means, you see, return is 3 only. So if the price of bond is high, means the return will be less. That means the interest will be less. So when central banks start buying bonds, the interest rates will actually come down. So can I write this? Interest will come down. Interest will come down. So when interest come down, what does that mean? Do you think the firms will invest more now? Because interest is less, money is cheap. So investment will increase or decrease?
Increases, sir.
Investment will increase. So investment will increase means, do you think this will affect the growth positively? Yes.
Positively, sir.
So economic growth will increase, and also when all these things are happening, there will be a positive market sentiment also will be. Positive market sentiment will also be there. So that will be reflected in share market and everything, stock exchanges. So overall there will be a positive sentiment. So this is how you can reflect, and that will promote growth, that will prevent any recession or anything. Okay. Now what will be the impact on other countries or developing countries? What will happen here? What will happen in India? For example, if you talk impact on India, what will happen in India? Tell me.
So less FDI will come.
Less FDI. Why less FDI? Because they are getting more money. All those money will be invested in developing countries, no?
So they will invest in their own country.
No. Their own country, if they invest, the return is very less. Their interest rate is already less. So they take money and they will invest in other countries where the interest is slightly higher.
Increase in FDI, sir.
So that lead to increase in FDI. In terms of FDI, fund is there. In terms of FIIs also it will come. So it will come in the share markets, etc. Right? So first of all, FDI is actually good. So FDI will increase. Foreign direct investment. I'll tell you what is this difference and everything we will discuss. FDI will increase. Foreign, this institutional investors, the portfolio investment, PFI will also increase, right? So this portfolio investment is coming where? It is basically in the stock exchange, in buying and selling the shares, right? So it will come in stock exchange. What will happen with forex? Forex increase or decrease?
Increases, sir.
Forex increase. That means more dollar will come. So supply of dollar will increase or decrease? Supply of dollar will increase or decrease?
Increases, sir.
So what will happen with the rupee? Appreciate or depreciate?
Appreciates.
So this lead to rupee appreciate. I'll show you in the graph if you want. See, this is what actually going to happen. So this is demand for dollar and this is supply of dollar, right? This is a current position, let's say 75. So imagine quantitative easing was going on. So funds will come. So it will come in dollar. So supply will be increased. Supply of dollar increase means it will shift rightward or leftward?
Rightward.
Rightward shift. Okay, so this curve shift rightward. So you can see here the price of dollar is actually coming down to 60, 65, etc. So this lead to appreciation of rupee. So what do you think? Overall, all these are good or bad for India? Rupee appreciate, forex is coming, investments are coming, stock exchange is coming, and you know when this is coming, the Sensex will increase. All these are positive or negative?
Positive, sir.
All these are positive. Then why we criticize? Why we don't want this too much, or why people criticize for this quantitative easing and everything?
Because appreciation of rupee will decrease or export.
No. That is good. Even rupee appreciate itself is actually good. That create positive market sentiment and everything. That is not the problem. This is a stimulus. This can be withdrawn. This quantitative easing can be withdrawn anytime. Tapering can come at any time. So instead of buying the bonds, they can start selling the bonds also. So this is just a stimulus measure and this is not permanent. So the reverse will happen. That is what we call as quantitative tapering. Okay, the tapering of QE. So when the tapering will happen, what will happen there? They will sell the bonds, so the interest rate will increase. So instead of investing in country like India, they will withdraw all these funds. So suddenly they will withdraw from the stock exchange. Okay, so what will happen? The Sensex will collapse. That will affect the entire market and rupee depreciate like anything because they keep on demanding dollar. There will be demand for more dollar. So all these will happen suddenly. So that lead to, developing countries will face a huge problem in the situation of tapering. You got it? So that is the impact. So overall positive impact is there when quantitative easing is going on in US or any Euro developed countries. Our stock exchange, our Sensex and everything will go better. But the problem is these PFI, FDI is okay. This is long-term investment. PFI will go back. Forex will go back. So rupee depreciate. Sensex, the index will collapse. So all these are the problems. So what you can do is you can write the opposite, that is tapering of QE. Next is tapering of quantitative easing. Tapering means gradually reduces. Okay, so it means gradual withdrawal of quantitative easing. Gradual withdrawal of quantitative easing. So what will happen? Foreign investment, what will happen? It will decrease. What will happen with rupee? Rupee depreciate. Okay, why? Because forex will come down. Forex come down means dollar demand will be more now. So rupee depreciate and stock exchange indices will fall. So this is what actually the reverse will happen in the tapering. So quantitative easing is actually good, but the problem is, it will affect developing countries very badly as it is just a stimulus measure and we don't have any control over it. So I hope you understood this. Okay. Hello.
Okay, sir.
So we are done with this module. Any doubts you can ask. Tomorrow we'll start. Not tomorrow, Monday we will start the next module.
Sir, can you just come again with the quantitative easing definition, sir?
Quantitative easing.
Yes, sir.
First one.
Definition. Yes, sir.
Not definition. It is an unconventional monetary policy measure which seek to stimulate economic growth or counter recession by increasing aggregate demand in the economy.
Okay, sir. Got it, sir. Thank you.
Yeah. So can we stop here? Any doubts?
sir,
Yeah, tell me.
have you covered that monetary policy committee?
That that we will discuss under inflation.
Okay, their review of bi-monthly reviews.
Inflation. In the chapter of inflation, we'll discuss.
Okay, sir.
Yeah.
Thank you, sir.
Yeah. So we will stop here.
Okay, sir.
Okay.
Yes, sir.
Yeah. See you.